Just like the way we run businesses or even our lives, that's the same way the government does it. It has assets and liabilities. One of the ways it has liabilities is coming to the market to borrow. So we had covered how you can invest in treasury bills. The other way that the government gets money is through offering bonds. And bonds come in different manner. There is those that have fixed coupons, so you know when you get your coupon on an ongoing basis. And there is also what are called infrastructure bonds. For the infrastructure bonds, you actually know what project is going to be financed by the money that they come for. So over the time, we have seen the government come and borrow from the market. There are very many bonds that are issued in the market. And you as an investor, you can actually choose which tenor or what is the time to maturity you want to invest in. So on a monthly basis, the government will always come to the market, what is called a primary market, and say, this is what I'm offering. I'm offering a bond that is going to mature in 20 years. I'm going to offer a bond that is going to mature in 5 years. And you as a client, you actually determine what you want. So a bond is really lending to the government. And as you lend to the government, you get a return in return. So then the question is, why should I lend to the government with all the noise that maybe goes on? Why should I invest in government? One of the key things that for us to determine and to understand is that lending to the government is the most riskless investment that you can make. So if, for example, you're thinking about investing and getting a return of 10%, at least for the government, you are sure that you're going to get that money back. That's one part. The other thing is when you're investing in government, some of them provide you some tax shield. By tax shield is if you do your business, you're going to be taxed at 30%. If you invest in government securities, some of them, any tenor that is above 10%, 10 years, you're going to be taxed at 10%. So you can actually look at the tax saving that you're making. For some investments, like in the infrastructure bond, it is completely tax-free. So you can actually think about it. If I'm getting a 15% return from an infrastructure bond, it means that in effect, I'm getting 18%. That's what is coming to my account. So we invest in government security so that, yes, one, we feel patriotic, we're actually participating in what the government is offering. But the more important thing is like you're getting a good return without necessarily putting in a lot of time. What are the ways in which you can invest in government securities? I can actually decide to invest in government security directly. So I open a CDS account through central bank as the agent of the government, or I can go indirectly, whereby I go through what is called a nominee account or an omnibus. Let me explain to each of them step by step. I want to invest in the next coming bond. So what I will do is I will go download the DAO CSD account, and then the basic process is really you need your ID, you need your KRA, and you need your bank. And then once you fill all those documents, you'll actually see what are the available bonds on offer that are going to come. Then you bid, and then once you bid, then you will be able to pay. So the important thing is that your bank account has to be linked to the DAO account. Reason being is once you're successful, you have bid and you're successful, that money will be debited. The money will be debited from your account. On maturity or when you receive a coupon, it will also be credited directly. So that is a very seamless process of investing. So between you and your relationship person in the bank, you should be able to complete that process. Then there is another way whereby the bank say, okay, fine, come and buy the bond through us. So your underlying asset will be the bond. So you'll say, I want this FXD bond, for I want to invest 1 million shillings. For that 1 million shillings, they will debit your account, and then you'll have the bond holding. But this will be as part of many other investors. So the banks will bid for you on your behalf. The important thing about them bidding for you is that the day you want to exit and sell, they can actually be able to buy that. But that comes at a cost. As they bid for you, if, for example, the return is going to be 15% for someone who went directly, maybe they will allocate it to you at 14%. But that gives you the advantage of more liquidity. The day you need that bond, you will be able to get it back. So those are the two main ways in which you can actually buy into a bond. Now, the beauty about a bond is that you can actually trade it. So it's not like a treasury bill. Once you buy into a bond, you can actually go to the secondary market through the brokers and be able to trade it. The catch is the volumes that are required for you to get a good deal, it's actually a lot. So most of the times the bonds will trade in lots of 100 million. So if you are investing your 100,000, you're investing your 1 million. If you wanted to trade, you could actually be what is called a price taker, and the risk lies there. So that's one of the risks of investing, whereby you're not investing for the specific objective. So your tenor is not the same as your investment. So you have a goal that you're investing for, but there is a tenor mismatch. When you're forced to sell, there is a probability actually you could face some risk levels. So one of the things to understand is that as you hold onto a bond, the interest rate risk is real, whereby if interest rates go up, the value of the bond that you currently hold is going to be slightly lower. So if you went to the market to sell, then you would actually maybe experience some loss. However, if we match our duration and tenor, then we will be fine, because your coupon will continue coming. If it's a 5-year bond, you know that every 6 months you'll be getting your coupons. If, for example, you invested in January, you know that in June